Housing used to be simple. You worked, you saved, you bought a home. In most countries after World War II, this wasn't a dream reserved for elites. It was the foundation of the middle class. Governments actively designed policies to make homeownership normal, affordable, and stable. Today, that world no longer exists. Across the United States, Europe, Canada, Australia, and even parts of Asia, housing has become the single largest financial stress point in people's lives. Prices rise faster than wages, rents consume record shares of income, and younger generations are quietly priced out before they even begin. Most explanations stop at inflation, interest rates, or population growth. Those factors matter, but they are not the real cause. What's happening to housing is not a temporary market cycle. It is the result of a deep structural transformation that turned homes from places to live into financial assets designed to store, protect, and multiply capital. To understand why housing is becoming unaffordable everywhere, you have to look beyond prices and into how modern economic systems now treat property itself. And once you see that shift, the crisis looks far more permanent than most people realize. Housing was never designed to behave like a high-growth investment, and for much of modern economic history, it did not. In the decades following World War II, governments in advanced economies treated housing as social infrastructure rather than a speculative asset, focusing on stability instead of price appreciation. Mortgage systems were tightly regulated, credit access was limited, and land use policies were designed to expand supply rather than restrict it, which kept prices closely aligned with wages. Home ownership was intentionally made achievable for average households without requiring extreme levels of debt, because policymakers understood that secure housing produced social stability, consumer confidence, and long-term economic growth. This balance began to erode in the late 20th century as economies shifted away from manufacturing toward finance and services, creating a need for new channels to absorb excess capital, and housing gradually filled that role. Mortgage markets were deregulated, credit became easier to access, and property was reframed as a primary tool for wealth accumulation, rather than a basic necessity. At first, this shift appeared beneficial, as rising prices made homeowners feel wealthier, banks generated fees, and governments collected higher tax revenues, but the system quietly became dependent on continuous price growth to remain stable. Once housing entered this financialized framework, affordability ceased to be the central objective, scarcity became profitable, stability became secondary, and prices stopped reflecting what local incomes could support, instead responding to what global capital flows were willing to pay. This structural transformation explains why housing crises now appear simultaneously across countries, with vastly different cultures, policies, and demographics, revealing that the issue is not local mismanagement, but a shared design flaw embedded in the modern economic system. And once housing is treated as an asset first and a place to live, second, affordability becomes incompatible with the way the market is expected to function. If housing was redesigned to serve capital rather than people, the next question is, who benefits most from this shift and who is quietly being pushed out? The group that benefited most from housing's transformation was not individual homeowners, but financial institutions that learned how to extract predictable returns from property markets. As mortgage lending expanded, homes became collateral for an ever-growing web of financial products, allowing banks and investors to profit not just from ownership, but from the flow of debt itself. Securitization turned mortgages into tradable assets, spreading housing risk across global markets, while also increasing demand for more lending because every new loan generated fees, interest, and investment opportunities. This fundamentally changed incentives. Instead of asking whether borrowers could sustainably afford homes over decades, the system prioritized volume, turnover, and price appreciation. Rising prices were no longer a warning sign but a requirement, because falling values threatened balance sheets, pensions, and credit markets tied to housing-linked securities. Governments reinforced this shift by protecting mortgage markets during crises, signaling that housing prices would be defended even at the cost of broader economic distortions. Over time, this created a one-way dependency where policymakers feared price declines more than affordability collapse, locking the system into a cycle where interventions supported asset values rather than living standards. As capital flowed more freely into housing, prices detached further from local wages, turning ownership into a financial gatekeeper rather than a social norm. This explains why even regions with stable populations and modest job growth experienced explosive price increases as housing markets increasingly responded to financial demand instead of human need. Once homes became vehicles for debt expansion and asset preservation, affordability stopped being a metric of success and became collateral damage, quietly accepted as the price of maintaining financial stability. But financial institutions weren't the only players reshaping housing, because the next shift came when global investors entered local property markets at scale. As financial markets matured, housing stopped being a local asset and became a global one, attracting capital far beyond the communities where properties were actually located. Large institutional investors, pension funds, and asset managers began viewing residential real estate as a stable, inflation-resistant store of value, especially in a world of low interest rates and volatile equity markets. This shift mattered because global capital does not behave like local buyers. It is less sensitive to prices, less dependent on wages, and far more focused on long-term returns and asset preservation. When these investors enter housing markets, they do not just compete with households. They reshape pricing dynamics entirely by setting floors under prices and absorbing supply at scales ordinary buyers cannot match. Even when institutions do not directly purchase single-family homes, their influence raises valuations through land acquisition, development financing, and rental platforms that prioritize yield over affordability. Governments often welcome this capital, viewing it as investment rather than competition. But the consequence was a structural imbalance where housing markets began serving international balance sheets instead of local residents. This globalized demand helps explain why housing affordability deteriorated simultaneously across countries with very different housing policies, cultures, and demographics, because the driver was not local demand, but synchronized financial behavior responding to the same global monetary conditions. Once housing became an international asset class, price discipline based on local income collapsed, making affordability increasingly irrelevant to market outcomes. Yet global capital alone does not fully explain the crisis, because supply constraints quietly amplified these pressures in ways most people underestimate. While demand-side financialization receives most of the attention, housing affordability would not have collapsed so severely without structural supply constraints that magnified every surge of capital entering the market. Over decades, zoning laws, land use restrictions, environmental regulations, and local political incentives combined to slow new construction, especially in high-demand urban regions. These constraints were often justified as preserving neighborhood character or protecting the environment, but their economic effect was to limit elasticity in housing supply, meaning prices rose rapidly when demand increased and rarely fell when it weakened. Unlike consumer goods, housing cannot be easily or quickly scaled in response to market signals. And when supply becomes politically restricted, scarcity becomes a permanent feature rather than a temporary imbalance. Financialized demand colliding with constrained supply created a self-reinforcing cycle where rising prices justified further investment while discouraging policies that might lower values, because existing homeowners became financially dependent on appreciation. Governments at local and national levels increasingly relied on property taxes and construction-related revenues, tying public finances to high valuations and reducing incentives to prioritize affordability. This explains why housing shortages persist even in regions with ample land and advanced construction capacity, as the problem is not physical scarcity, but institutional design. Once supply constraints are embedded into governance structures, housing markets become structurally incapable of absorbing population growth, investment flows, or policy shocks without translating them directly into higher prices. But even with tight supply, housing would not feel this unaffordable without another force quietly stretching buyers to their limits: debt. Debt became the hidden mechanism that allowed housing prices to rise far beyond what wages alone could support, masking the true scale of the affordability crisis. As interest rates declined over decades, monthly payments became the primary metric buyers focused on rather than total price, allowing lenders to justify larger and larger loans without appearing to increase immediate burden. This shift changed how households evaluated affordability, stretching loan terms, increasing leverage, and normalizing debt levels that would have been unthinkable in earlier generations. Easy credit did not make housing cheaper. It made higher prices possible by pulling future income into the present. Each expansion of borrowing capacity pushed prices upward, which then required even more debt for the next buyer, creating a ladder that grew harder to climb with every rung. Governments reinforced this dynamic by subsidizing mortgages, guaranteeing loans, and intervening during downturns to stabilize credit markets, effectively socializing risk while privatizing gains. Over time, housing affordability became dependent not on income growth, but on continued access to cheap and abundant debt, making the system extremely sensitive to interest rate changes. When rates rise, buyers are squeezed immediately, yet prices often remain elevated because existing owners and investors resist selling into losses. This debt-driven structure explains why affordability deteriorates even when construction increases or populations stabilize, because prices are anchored to financing conditions rather than economic fundamentals. And when debt reaches its limits, the burden does not disappear. It shifts, transforming housing from a path to ownership into a permanent rental system. As ownership became increasingly unreachable, the housing system adapted by expanding the rental market in ways that further entrenched unaffordability. Investors who accumulated property portfolios during periods of cheap credit transitioned seamlessly from selling homes to extracting steady rental income, turning housing into a long-term cash flow asset rather than a pathway to ownership. This shift was not accidental because rising rents became necessary to justify elevated property valuations once price growth slowed. Rent levels began reflecting required returns on capital rather than the incomes of local tenants, locking renters into a cycle where saving for ownership became nearly impossible. Large-scale landlords gained advantages through data-driven pricing, scale efficiencies, and political influence, allowing them to set market benchmarks that smaller owners followed. Governments often tolerated or supported this transition, viewing rental expansion as a solution to housing shortages without addressing the underlying affordability problem. Over time, housing markets began resembling a dual system where owners benefited from appreciation and leverage while renters absorbed volatility and rising costs without gaining equity. This transformation explains why affordability feels worse even when vacancy rates appear stable, because the burden is being redistributed rather than reduced. But this shift toward permanent renting also carries deeper economic consequences that extend far beyond housing itself. The broader economic consequences of housing unaffordability are often underestimated because they unfold slowly, but they are reshaping entire societies. When a growing share of income is absorbed by housing costs, households have less capacity to spend, save, or invest elsewhere, quietly dragging down consumption, entrepreneurship, and long-term growth. Younger generations delay family formation, mobility declines as people remain locked into expensive locations, and labor markets become less flexible because workers cannot afford to move where jobs are created. Wealth inequality widens as homeowners accumulate appreciation while renters see rising costs without asset accumulation, reinforcing generational divides that persist over decades. Governments face mounting pressure as housing stress increases demand for subsidies, social housing, and emergency support, while tax bases become increasingly dependent on maintaining high property values. This creates a political feedback loop where policies that might restore affordability are resisted because they threaten financial stability, public revenues, or voter wealth tied to housing. Over time, housing stops acting as a foundation for economic security and instead becomes a constraint that limits growth potential and social cohesion. The crisis, therefore, cannot be solved by marginal policy tweaks, because it is now embedded in how modern economies allocate capital, distribute risk, and define prosperity itself. If housing unaffordability is a systemic outcome rather than a market failure, the real question becomes whether any meaningful correction is still possible. Meaningful correction has become difficult because housing markets are now deeply intertwined with financial stability, political incentives, and household balance sheets, making any attempt to restore affordability feel economically dangerous in the short term. A significant price correction would reduce paper wealth for millions of homeowners, weaken banks exposed to mortgages, pressure pension funds invested in property-linked assets, and shrink government revenues dependent on property taxes and transaction fees. This creates a situation where affordability is widely acknowledged as a problem, yet actively fixing it threatens multiple pillars of the current economic order. As a result, policymakers often choose delay, mild interventions, or symbolic reforms that signal concern without changing fundamentals. Measures such as first-time buyer subsidies or tax incentives may help a small group temporarily, but they often push prices higher by increasing purchasing power without addressing supply, financialization, or debt dependence. Over time, these policies normalize unaffordability by treating it as a condition to be managed rather than a failure to be corrected. This explains why housing crises persist across election cycles and economic environments, surviving recessions, booms, and policy shifts with remarkable consistency. Once housing becomes too big to fail, affordability becomes too disruptive to prioritize, leaving societies trapped in a system that everyone recognizes as broken, but few are willing to dismantle. Yet history shows that economic systems do eventually change, often under pressure, which raises the question of what kind of housing future this path is leading toward. If current trends continue, housing is likely to evolve into a system that increasingly resembles a permanent divide between asset holders and asset payers, with ownership concentrated among those who already possess capital, while the majority finance that ownership through rent and debt. This trajectory mirrors historical patterns where land ownership defined power, security, and social status, except now it is mediated through modern financial institutions rather than feudal titles. As housing consolidates into fewer hands, market dynamics shift further away from affordability and toward yield optimization, reinforcing high prices even during economic slowdowns. Technological tools, data-driven pricing, and centralized ownership models accelerate this process by reducing friction and coordinating market behavior at scale. At the same time, demographic pressures intensify the divide. as aging homeowners rely on housing wealth for retirement while younger generations face declining access to ownership, locking inequality across lifetimes. Without structural reform, housing risks becoming a mechanism that transfers income upward indefinitely, reshaping class structures and limiting social mobility in ways that persist for generations. This future is not the result of malicious intent, but of incentives embedded in a system that rewards capital preservation over broad-based stability. The final question, then, is not why housing became unaffordable, but what it will take for societies to reverse a system that no longer serves its original purpose. Reversing housing unaffordability will not be easy, because it requires confronting incentives that are deeply embedded in modern economic systems, rather than fixing a single policy mistake. Restoring affordability would mean accepting slower price growth or even declines, redesigning credit systems to limit excessive leverage, reforming land use rules that institutionalize scarcity, and redefining housing as social infrastructure instead of a primary investment vehicle. These changes challenge powerful interests and short-term political calculations, which is why meaningful reform has been repeatedly postponed. History shows, however, that economic systems do not remain stable when they stop serving the majority. When housing absorbs too much income, suppresses mobility, and concentrates wealth, it eventually constrains growth itself, forcing change through crisis or deliberate reform. Whether societies choose gradual adjustment or abrupt correction will determine how painful that transition becomes. Housing can once again function as a foundation for stability rather than a source of perpetual stress, but only if it is removed from the center of financial speculation and returned to its original role as a place to live, build families, and anchor communities. If you want to understand how housing, debt, inflation, and financial power structures are reshaping everyday life around the world, follow this series and watch the next videos where we break down the systems behind today's existing economic pressures and what they mean for your future.